Crypto was in the midst of one of the worst market crashes in history less than a month ago. Since the peak of the bull run last year, Bitcoin and Ethereum have fallen by more than 70%. Numerous well-known cryptocurrency businesses, including the hedge fund Three Arrows Capital and the cryptocurrency lender Celsius, filed for bankruptcy. The industry's value had dropped below $1 trillion, a significant drop from just a few months ago when it was worth more than $3 trillion. Investors, however, remain optimistic that the recent shakeout is finally coming to an end. What's the cryptocurrency's market future and how should investors react? What do macro guru and Real Vision CEO Raoul think about the market?
Yeah, I mean, I looked at this and actually I use, monetary tightening as in the rate of change of monetary tightening plus commodity prices plus inflation, all of this stuff and the dollar. I think it's the largest tightening of monetary conditions in all economic history as far as I can find. And it just happened really fast. So, yeah, as you said, this is not a crypto event. This is just a liquidity event. So the financial conditions are priced in an ISM of 35. So the pain of tightening is already in the market. So the probability is that the other side of a recession where conditions loosen is the thing that eventually gets priced in. So as Sam kind of suggests, is that the markets have now, crypto markets, and I showed that with that M2 chart, have priced in this full thing. So it's already there. Again, the Fed are a kind of noise because it's the actual bond market that does the tightening, not the Fed. So the Fed, wherever they are in rates, is irrelevant because the bond market, pushed it all the way up to 3.6% or whatever it did in 10-year rates, and same at the front end. So I think it's a lot of the bad news, however much that is, whether it's 80%, 90% or 100% is in the price. And Sam sees that from the market clearing itself within crypto. How many of the bad positions have been washed out now as we've seen this kind of long-term capital management style blow up where everybody was lending to the same counterpart. And then when the counterpart goes under, everybody goes under. And I've lived through that before. And we talk about that in the interview quite a lot, about how similar it is to long-term capital management with the Three Arrows Capital blow up and how Celsius is linked to it and everything else. So, yes, normally these things are towards the end.
The price of Bitcoin has been stuck between $19,000 and $22,000 as investors lick their wounds following a market crash brought on by tightening monetary policy and made worse by the May collapse of Celsius and the Terra USD stablecoin. From a record high of nearly $69,000 in November, it has decreased. Once the Fed's tightening cycle is over, some enthusiasts predict that Bitcoin will make up this year's losses. The total market value of digital tokens has surpassed $1 trillion.
I don't know yet whether we've seen the low. I think so, and I've been averaging it in aggressively, actually. The kind of biggest addition to my crypto bets since 2020 into this, but I don't know where the low is. Could a drop in economic conditions cause further short selling or panic? Possibly. I think the low is close. Whether it's in or not, I can't tell. But I know from all of my economic work, and I've probably got maybe 200 charts to back up all of the stuff I showed that suggest the balance of probabilities are that a lot of this has been priced, that we've got the inflation problem is probably a thing of the past, and that economic growth is going to fall sharply. Now, what happens when economic growth falls sharply is we now have this Pavlovian instinct of the market looking forwards and saying the Fed are going to pause and monetary conditions are going to ease. Now, don't forget that financial conditions index that I showed you, the global macro investor one, well, that prices in commodity prices and the dollar and yields. So if yields start coming lower, commodities start coming lower, and the dollar eventually tops out, which it's not clear that that's going to happen yet, but at some point it will, then you've got all of those reversing. And that tells you that usually that's when the Fed have started reversing course as well. There is another scenario that is very real, and the scenario is that I'm wrong, that the 1974 short, sharp contraction of the economy and contraction of markets is not that it's 2001-2 or 2008 all over again. In which case, you get a false rally that goes on for a period of time, and then it rolls over and has another whole set of lows. Those are the 50% sell-off style scenarios. I don't see that in the forward-looking data because I think it looks sharper and shorter than people expect, but that is a possibility. So it's really hard to call in these things, trying to pick lows and stuff is not easy because, many people got carried out in 2002. I remember it really well. Then 9/11 hit and then the whole thing rolled over again and it destroyed people. So, these kind of markets are not easy to trade. The bond market tends to be the easier trade, but it's been hard because of the inflation story has been so sticky. But when it gets easier, that's an easier place to make money. Listen, there could be, but we've got to get through a recession first before we start talking about the next cycle's inflation. Now, does inflation settle down to 3% or 2.5%? I don't know, but I do a chart of 5-year real rates, and they've been declining for 25 years now, and the trend rate of real rates is about -1%. But what Brad is seeing, and Brad has made some programs for us because he is incredibly smart, and he's all day in his truck looking at observing the economic conditions of the United States on the ground, that is definitely to do with onshoring. Manufacturing bases, supply lines are changing. I think it's temporarily good for jobs for construction, temporarily good for commodities because you need stuff to build stuff. But if you look at the Tesla factories, and the Amazon factories and the warehouses, the robots are winning. And the robots are very, very deflationary. So, we saw this again after World War II, we had a massive boom, a massive building boom. That building boom actually didn't generate that much inflation in the end. It generated it initially from the supply issues, and then it settled down. What we got was actually decent economic growth. I actually think the backside of this cycle is probably half decent economic growth if this onshoring continues and we get some fiscal stimulus, which I think is needed at a structural level in both Europe and the US. And I think things like ESG, the kind of coalescence of capital around that creates more of a boom because it creates technology, it creates a change of infrastructure, and these are good things. I don't necessarily think they're inflationary. Sure, things like copper could have a real tight spot, but copper, as we've seen, prices in the business cycle first, and copper's been going down like a lead balloon as opposed to a copper balloon. Now, the DXY also year on year works pretty well with the ISM, and it's currently pricing about 45, which is a recession. Now, so that tells me that we are closer to the end than the beginning of the move. But again, we could see that spike, that one last final spike in the dollar. And then that would tell me that the worst dollar scenario maybe is in due course in a couple of years' time. I'm most convicted on averaging in cryptocurrencies, which I've been buying. I've also been averaging in these growth tech stocks, the ARK type names. I've got a big basket of stuff to reduce risk in some of this, because it's very risky to buy markets that are down, but they're down 75, 80, 85%. And, technology is not going away. The exponential age doesn't go away because prices have gone to the bottom of the logarithmic channel. So, these are 2 to 3 standard deviations oversold. They look very attractive to me. But you need to have a long-term framework, and you need to be able to understand that you may still be wrong by 20, 30%. Who knows? And that not to be an issue because the upside is 10 times that. That's how I think about this.
What do you think about all of this? With this, we've come to an end. The content in this video is for educational purposes only and hence should not be considered financial advice. All the financial decisions should be made after doing your wide spectrum research. Also, make sure that you like this video, comment down your thoughts about this, and don't forget to subscribe to our channel to stay updated about the latest videos. Until then!